We have big news for Tesla stock and perhaps even bigger news for the state of the economy, with a massive miss on your private sector job report today. That is your ADP employment change. This sets a kind of bad narrative heading into Friday. I'll discuss that and much more in this video. But first, Tesla stock is pretty much break even at the time of recording this video, sitting below its 200-day moving average. So I will say, to start this video, you are vulnerable for an upside surprise. You've priced in a lot of bad news. We've had a lot of bad headlines. Do not be surprised if the slightest bit of good news, especially on deliveries, does start to rebound Tesla. You're also sitting at this trend line that I have marked from the lows that you hit back in April of 2024 at $138 per share. It seems like you're finding some support at that level, but we will have to see how the news flow comes out in the coming days. And before we get into all of your Tesla news today, look at this ADP employment change today. This came in at 77,000 job ads. The expectation was 140,000. That is a massive miss. And sometimes the ADP employment change, whether it's a big miss or big beat, can kind of foreshadow the jobs report, whether that's going to be weak or strong. And judging off of this ADP employment change, it's gonna be a rough jobs report on Friday, as we have previously predicted. For the summary of the ADP employment change, it says here, Private businesses in the U.S. added 77,000 workers to their payrolls in February 2025, the smallest increase in 7 months, compared to an upwardly revised 186,000 in January and well below forecast of 140,000. The service-producing sector added 36,000 jobs, led by leisure and hospitality at 41,000, professional and business at 27,000, financial at 26,000, while job losses occurred in trade, transportation, and utilities, negative 33,000, education and healthcare, down 28,000, and information, down 14,000. The goods producing sector gained 42,000 jobs due to construction adding 26,000 and manufacturing adding 18,000, while natural resources and mining shed 2,000 jobs. Quote, get this, policy uncertainty and a slowdown in consumer spending might have led to layoffs or a slowdown in hiring. Our data combined with other recent indicators suggest a hiring hesitancy among employers as they assess the economic climate ahead. Basically saying that the turbulence out of the White House really is just forcing companies to say, should we be hiring right now? And unless you absolutely have to be hiring, a lot of companies are starting to pause their hiring efforts. Now, we have a lot more to get into in terms of the macro, more economic data, as well as some big statements out of the White House today. But first, I want to share your Tesla stock news. President Trump announced last night during his joint session of Congress, he says, quote, "Thank you, Elon. You're working very hard. He didn't need this. We appreciate it. Everybody here, even this side here," pointing to Democrats, "appreciates it. I believe they just don't want to admit that." So yeah, Elon did receive a standing ovation, and I know a lot of people have mixed emotions right now about Elon, but I mean, it's publicity, which should be good for Tesla regardless. Now, this is some of the big news today for Tesla. It says the U.S. eyes zero tariffs on cars in India trade deal as Tesla's entry nears. The U.S. wants India to eliminate tariffs on car imports under a proposed trade deal between the two nations, but New Delhi is reluctant to immediately bring down such duties to zero, even as it considers further cuts. India's high auto tariffs will feature informal talks for a bilateral trade deal that are yet to begin, paving the way for Tesla, which is gearing up for an India launch. It has been reported in recent weeks that India is going to offer Tesla only a 15% tariff on their Tesla vehicles. Now, who knows the other parts of that deal, if that means Tesla needs to build a factory in India or what the other stipulations are long term, but that's a huge reduction from the currently over 100% tariff in India. And that is why, like, there's no Fords or GMs or any vehicles like that in India. The market's really dominated by Tata Motors that has like 80% market share in India. But again, as I've said before, especially with the cheaper, lower priced Teslas, as the Indian economy continues to develop over the coming years, India could be like Tesla entering China in 2018. Like it's going to be massive long term for the auto sector of Tesla's business. And here you can see on that note, Tesla India has started announcing a hiring event for sales advisors. Goldman Sachs is the next analyst to get a little emotional around Tesla and really spreading this misinformation. It's unfortunate, that you have analysts that should be more knowledgeable than average investors, and they are magnitudes. I don't want to say dumber because that's mean, but dumber than the average Tesla investor. Goldman Sachs here has cut its Tesla price target to $320 from $345. They say, quote, we lower our below consensus delivery estimates for Tesla, reflecting the quarter-to-date data for key regions, including China, Europe, and the US, as well as what we believe are broader demand trends. These people are stupid, okay? Let's just be honest. As long as we don't go into some kind of recession or something, there is nothing that indicates there is a demand problem for Tesla, okay? Like, almost gives you a headache when you're subjected to this kind of stupidity. There's no demand problem. Tesla switched their factories over to produce the Model Y. So that obviously had a delayed effect on deliveries. But again, it's common sense. You're not going to go out and buy the old Model Y when the new Model Y is coming out for essentially similar pricing. Okay? It would be a stupid thing to do. Okay? That's why you're seeing these slower deliveries in quote unquote Q1, which Q1 is not over with. Okay. That was expected. And let's be honest here. Tesla stock is down 44% from all-time highs. This is already well priced into Tesla stock. Like a Q1 miss on deliveries is expected. That's not going to be groundbreaking new information. What I think will be groundbreaking new information is when Tesla's deliveries actually start to excel again. When the new Model Y really starts to get cranking again at all Tesla factories. That's going to catch a lot of people by surprise and serve as a very bullish catalyst for Tesla. Because I've talked about this many times before here on the channel. Like it's so obvious, it's stupid. Like, again, even Roland Percher here says, and I shared this today on the X account. If you have not followed me over here, go ahead and give the account a follow. It's Michael Tyler. He says, Tesla Giga Shanghai reported 30,688 wholesale sales in China plus exports for February. The number is low due to the production switch to the new Model Y, as deliveries started the last days of February. March is expected to be strong. I mean, come on now. Look at it. Like Q1 or first quarter of the month, really not terrible in China. Sure, it is kind of average. It's not fantastic, but February is really bad. Big shocker. And I know I just went on a little bit of a tangent there, but it's so obvious to me. And maybe that's because we provide better coverage here on this channel, deeper coverage than analysts do. And unfortunately, my commentary doesn't move markets, doesn't move the stock. But when these uneducated, unfiltered analysts come out and just say things that are untrue, it moves the stock. It creates negative sentiment. It kind of sways retail investors with that misinformation. I mean, a lot of people believe just because you work at Goldman Sachs that you're smarter than the next guy, which clearly is not the case. Now, also in the news today, Mustang sales are tanking. And Well, that's probably because, well, Tesla is a better alternative. And Trump announced today he is considering a 1-month delay for automakers from newly imposed 25% tariffs on Mexico and Canada. And Elon Musk has retweeted a post saying that Tesla's FSD is the best performing self-driving in China, which I think could also help to boost sales in China in the coming months. Just my opinion, but we'll have to wait and see. Tesla has officially signed a 5-year lease agreement in India on a showroom. Donald Trump also announced last night that he wants to make interest payments on, quote, made in America cars deductible, which would be very bullish for Tesla. And I think this is the way to go to really boost the US made auto market, right? That's going to be a big deciding factor for a lot of people that want to, buy a new vehicle, right? If you can deduct the interest payments on your car, that's huge. Now, also in the news today, White House Press Secretary Leavitt says U.S. and Ukraine talks are happening as we speak. She says that Trump is committed to the peace deal and that they may resume funding for Ukraine in the meantime. White House Press Secretary says the Trump administration is doing everything they can on inflation, which is actually kind of interesting because just about an hour ago, U.S. Commerce Secretary Lutnick says there is going to be a short period of time where there are high prices on certain items following tariffs. I mean, it's kind of back and forth, right? What is it? Is this going to help inflation? Is it going to hurt inflation? I don't think it can help inflation, but it can weaken the economy, which in and of itself is deflationary, or at least disinflationary. It was also reported that Trump and Trudeau held a call today that was about 50 minutes long, and the call with Trudeau ended in a, quote, somewhat friendly manner. The markets have really been reacting to some rumors today that there may be a concession to the tariffs, that there could be some deal being reworked right now that would potentially meet Trump in the middle on 25%, like 15% potentially, with Canada doing some other concessions. Now, what I actually think is going to happen is there is going to be a concession to meet in the middle around 15% on tariffs, but I do think there's probably going to be some kind of larger commitment to buy 10-year treasury yields, longer dated treasuries, to bring down interest rates. I think that's kind of what the signs are pointing to, but we'll have to wait and see. U.S. Commerce Secretary Lutnick does again confirm the April 2nd tariff agenda is still coming. Those are those reciprocal tariffs. And apparently the U.S. Sovereign Wealth Fund will be financed by tariffs, according to sources, which actually did give the markets a little bit of a rally when this news came out, because, I mean, it would be the government buying essentially stocks. So who doesn't love that if you're a greedy capitalist like we all are? And again, Trump's trade advisor Navarro says Trump was right. There will be some tariff disturbance. He also did acknowledge that we've had 2 days of volatility in markets, and last I checked, to be fair, I think it's been more than 2 days. And Navarro says that Trudeau should, quote, tone it down. This morning, we did get EIA crude oil inventories that came in at 3.614 million. The forecast was 0.8 million. What's interesting about that, given the data that we had out today with the ADP employment change that massively missed estimates, is you have more inventory of oil, which is, helping to bring down prices essentially. You have a weaker economy, and you have the OPEC plus output increase that is causing oil to fall 3% today. And I think this is a story of the inflation dynamic that not a lot of people are going to talk about. But as oil falls, it is going to, help bring down inflation for really everything, okay? And could offset some of the tariffs that, could continue, okay? No matter what it is, okay? No matter if it's this Lipton green tea, or it is this Roku remote, or it is this cup that I had coffee in. I didn't produce any of that. It was produced somewhere, shipped somewhere else, shipped to a store, and I drove and bought it, okay? So even if it's not necessarily something that is made with oil, oil touches everything that we use, that we do not personally produce. And I think that's important to remember, and that's why oil has such a deep impact on inflation, from really the roots of the product. And Canada said this morning before the call with Trudeau and Trump that Canada won't end tariffs unless all US tariffs are lifted. And another headline that the markets really liked was the White House press secretary, Leavitt, that says Trump is open to hearing about additional tariff exemptions. The Fed Beige Book did come out as well today. I will read you the overall economic activity. This is something Fed Jerome Powell himself has said, if you ever think the economic data is a bit, back and forth, just read the Fed Beige Book, and that'll tell you kind of what the Fed is looking at and how they're looking at the economy. So it says here, overall economic activity rose slightly since mid-January. 6 districts reported no change, 4 reported modest growth, and 2 noted slight contractions. Consumer spending was lower on balance, with reports of solid demand for essential goods mixed with increased price sensitivity for discretionary items, particularly among lower-income shoppers. Unusual weather conditions in some regions over recent weeks weakened demand for leisure and hospitality services. Vehicle sales were modestly lower on balance. Manufacturing activity exhibited slight to modest increases across a majority of districts. Contacts in manufacturing range from petrochemical products to office equipment. Expressed concerns over the potential impact of looming trade policy changes. Banking activity was slightly higher on balance among districts that reported on it. Residential real estate markets were mixed, and reports pointed to ongoing inventory constraints. Construction activity declined modestly for both residential and non-residential units. Some contacts in the sector also expressed nervousness around the impacts of potential tariffs on the price of lumber and other materials. Agricultural conditions deteriorated some among reporting districts. Overall, expectations for economic activity over the coming months were slightly optimistic. So actually not a bad Fed Beige Book at all compared to what we have gotten recently. On prices, the Fed Beige Book says, prices increased moderately in most districts, but several districts reported an uptick in the pace of increases relative to the previous reporting period. Contacts in most districts expected potential tariffs on inputs would lead them to raise prices, with isolated reports of firms raising prices preemptively. As far as labor markets, employment nudged slightly higher on balance, with 4 districts reporting a slight increase, 7 reporting no change, and 1 reporting a slight decline. Multiple districts cited job growth in healthcare and finance, while employment declines were reported in manufacturing and information technology. Labor availability improved for many sectors and districts, though there were occasional reports of a tight labor market in targeted sectors or occupations. Contacts in multiple districts said rising uncertainty over immigration and other matters was influencing current and future labor demand. Wages grew at a modest to moderate pace, which was slightly slower than the previous report, with several districts noting that wage pressures were easing. So overall, that's pretty good, showing some weakness, but not terrible. This morning, we did get the ISM services PMIs as well. On the headline number, it came in pretty good at 53.5 versus estimates of 52.6, and last month was 52.8. And this is something that I was talking about yesterday. You really can't have too much weakness at all in services, considering manufacturing is so weak. Manufacturing is about 20% of the economy, services 70, 80-ish% of the economy. Any weakness in services really brings up that recession fear. So you didn't exactly get that today. So that's good overall for the growth concern, and that's a positive development, I would say, for the markets. Now, factory orders month over month also came in strong at 1.7% versus the estimate of positive 1.6%. Business activity came in at 54.4 versus estimates of 54.2, so that beat. Employment came in at 53.9, beating estimates of 52.1. New orders came in at 52.2 versus estimates of 51.2, and prices paid came in at 62.2 60.6 versus estimates of 60.0. So prices came in a little bit hot, but all other metrics came in good. Now, what I will tell you about this is essentially a survey. Okay, it's not hard data. So keep that in mind, that it's not the biggest thing markets are going to react to. The bigger things that markets will react to will be the Friday jobs report. And I think that's really what we want to be looking out for, because that's the next big catalyst to tell us, hey, are we going into a, slower growth environment? Are we going to start seeing some growth concerns? Or was it overblown to begin with? Tomorrow, we will get more important economic data as well. Challenger job cuts, expecting that to rise to 56,000. That is essentially planned layoffs, so keep that in mind. We will get a balance of trade report, exports and imports. This will give us a new GDP update from the Atlanta Fed. It's currently at negative 2.8%, which scared a lot of people. But with tomorrow's data, you could see this bounce up quite a bit, as long as those export numbers do not come in substantially weaker than the import numbers. Okay, that's what goes into your GDP report. You will also get initial jobless claims tomorrow morning, expecting 235,000. Again, if that comes in too high, growth concerns are back. Keep that in mind. You will also get wholesale inventories month over month, which will feed into that new GDP update from the Atlanta Fed. You will get a speech from Fed Waller as well at 3:30 p.m. And this leads us into the Friday jobs report with the non-farm payrolls, the unemployment rate, and Fed Bowman, Fed Williams, Fed Kugler, and Fed Jerome Powell that will be speaking Friday afternoon. Now, Jim Cramer says he does not see a trade deal on the horizon and that optimism might be misplaced. So if the inverse Cramer effect holds true, that means here soon, we're going to get a deal. But something I do want to point out to you guys, Liz Young Thomas on X says the average of the ISM manufacturing and services prices paid component rose to 62.4 in February, the highest since June of 2022 when inflation peaked. There could be real pressure building, and if it doesn't cool off soon, we could actually see inflation turn higher. You can see this dotted purple line here tends to spike before inflation. Now, again, this is a survey. The ISM is a survey of expectations of inflation, essentially, in the manufacturing and services sector. I think the tariff dilemma is really why these expectations are moving higher. And I mean, Trump, the White House, they're literally telling you to expect some kind of inflation, at least short term, from tariffs. We're probably going to get that. And that's the issue here. If the economy continues to weaken, the Fed's not really going to be able to go out and ease policy too much. So we're going to be in a very tricky situation here soon, balancing inflation and trying to balance the economy. Mnuchin, which was the Trump 1.0 Treasury Secretary, says it's pretty clear the Fed is going to lower rates. So, of course, we're expecting the Fed will lower rates this year. Question really is when and why. If the Fed is forced to cut rates because the economy sucks, that's not exactly great for stocks. But if we don't get the inflation that now some people are forecasting, that's going to be really good for markets if the Fed is able to cut because of that. Here on the day today, let me give this a little bit of an update. CNN's Fear and Greed Index is coming in at 21, really staying stable down here in extreme fear. Yesterday, you were at 19, so you're really not moving too much, and there's still a considerable amount of fear out there. The market momentum component, extreme fear, stock price strength, extreme fear, stock price breadth, extreme fear, put and call options, extreme fear, market volatility, extreme fear, safe haven demand in extreme fear. The only thing not in extreme fear is junk bond demand, and that is in extreme greed, which is fascinating. The percent of stocks trading above their 50-day moving average today is recovering a bit to 30.6%, up 1.5% today. Overall, this is good, but you're still, again, in a very weak place and nothing has really changed. And coming tomorrow, we will be getting a new AI investor sentiment survey. And last week, this came in at the most bearish you have seen since the lows of 2022. Really, investors last week were as bearish as, normally when the S&P is down over 25%. Like, you are at levels of fear you don't ever see unless you are deep in a bear market. So we've only fallen since then on markets. Does sentiment improve, or does sentiment come in even worse? I think that's going to be another very fascinating sentiment data point that we will get tomorrow. Now, here on the day today, the big loser is really TLT and long duration bonds. Some of the inflation concerns definitely working their way into the bond market, whereas, again, there was bad data as well today with the ADP employment change, but bond investors are focusing more on the inflation comments that we got today out the White House, and now the Fed Beige Book, and well, they don't like any of it. So the odds of Fed cuts are moving lower today. Yesterday, there was about a 41% chance of a Fed rate cut May 7th. Now that is sitting at 37.3%. So you did fall about 4 or 5% ish in Fed pricing for a May 7th cut. Wall Street is currently expecting the first cut from the Fed coming June 18, 2025, with a 52.6% probability. What is interesting, though, is you're pricing in a greater probability of 2 rate cuts by June than no rate cuts at all by June. So 2 rate cuts by June is priced at 25.2%. 3 rate cuts is priced at 1.4%. That would be kind of wild. And no cuts by June is only priced at about 20.8%. So you are leaning more towards multiple cuts by June versus a continued pause. Just in the time of recording this video, Tesla stock is now up almost 2% on the day today. And that's just how volatile markets have been recently. Within the course of 20 minutes, you could be in deep red territory, and then be green, and then back to red 20 minutes later. So it's just a very difficult environment, especially if you are trying to trade this. I think cash is king right now. Get out of margin, be ready to buy if prices do go lower, and be prepared for a bounce, because I do think we're going to get a larger bounce soon, just overall as markets have fallen almost 7% from all-time highs before the rally that we had today on the SPY. Nonetheless, as far as Tesla stock is concerned, you have 169 different trades totaling $116 million with a positive order value of 23%. Does not look good in the options market today for Tesla. But what does look good for Tesla is about 604,000 shares today that are being covered by hedge funds and institutions. I mean, that's a lot. Hedge funds and institutions are continuing their exodus of their short positions in Tesla. It makes sense. Again, the stock's down like 45% from all-time highs. You would expect to see shorts covering on short positions, but not if they were bearish on Tesla. If they were bearish on Tesla, they would be adding to their short positions, okay? That's not what we're seeing. That is a very good sign that the crash could be over soon for Tesla stock. And Google Trends levels for Tesla look healthy. I mean, normally this is a pretty slow period of the year for Tesla. Once we get deeper into March, you do tend to see search trend activity pick up, and that's something I will be on the lookout for. But there is virtually no change at all for Tesla's search trend activity, besides the Cybertruck fell from 16 down to 14. All of your other models are the same as they were yesterday. You can also see that Tesla continues to run about 4,000 different ads with Google, so continuing their advertising campaign, and Tesla's global inventory numbers continue to fall across the board. The Model Y now at about 4,800 vehicles in inventory, Model 3 at 3,700, Model X at 1,900, Model S at 1,300, and the Cybertruck at about 1,000. Now, if you really think Tesla is having a demand problem, you want to look at the inventory numbers. If inventory is starting to build, that's a problem, because even before Tesla's demand slows down, Tesla would start accumulating more inventory. And we're not seeing that as of now. So low inventory typically means good demand. Okay, inventory that starts to rise would be a red flag. And you're, again, seeing the opposite of that. Inventory is continuing to fall, especially for the Model Y. And again, I do think Tesla can bounce here. I think Tesla could actually bounce back up to that 310 level. We're very vulnerable right now to headlines. And overall, I mean, Tesla's below its 200-day moving average. It doesn't usually stay there for too long. Tesla stock is oversold as well. I believe the second longest it's ever been oversold before. Typically, when you get oversold on Tesla, the stock tends to bounce. And I think you are just primed and ready for that bounce at any point. And don't be surprised if it happens in the near-term future. And again, honestly, the stock down 44%, like, you've already priced in a lot of bad news. I think you're really going to have to see this market deteriorate a lot more from here to get an even larger crash short term for Tesla. Ultimately, I think markets will move lower, but it'll be choppy. You'll get bounces and aggressive rallies, aggressive falls. And I think anytime now you could be due for an aggressive rally, especially in Tesla. Let me know what you guys think about all of this information down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day, and I will see you in the next one.